Good morning. I'm Ron Wirtz. I'm Regional Outreach Director for the Federal Reserve Bank of Minneapolis. I'm here today to discuss some results to a recent survey of businesses located across the 9th District. The bank is obviously very interested in economic conditions across the 9th District, which runs roughly western Wisconsin and the UP of Michigan over to Montana. But because we have a lot of data lags in terms of trying to follow businesses, what we're doing is we're going right to businesses to have them tell us how things are at their business, and we want to be able to share that information with you. So I'm going to do that today. Before I get into the survey results themselves, I just need to offer this quick disclaimer that the views here expressed are mine and not necessarily those of the Federal Reserve System or the Minneapolis Fed itself. So I want to let people know that this particular session is part of a rec webinar series from the Minneapolis Fed that actually stems from an annual conference that we have in January. We had it just about a month ago. And the purpose of that conference, that I believe we've done it for 4 years now, is to try to connect more people and the research that's being done on the 9th District economy. Right now, we are doing a lot more surveys to connect us to businesses across the district so we can have a more organic idea of what's happening to the economy in the 9th District. And when we find out, when businesses do talk to us, we use these webinars to help disseminate and discuss those findings so everybody learns about current economic conditions. I want to give a quick shout out to all the partners that help me with surveys. For this particular survey, there are about 50 partnering organizations across the 9th District and some in every state in the 9th District. There are a lot of chambers of commerce, economic development organizations, even some government agencies, and some other business and trade organizations that help me get the survey out to their membership, their professional networks, to get our survey into the hands of more businesses. I'm always looking for additional partners. The more widespread this survey is, the better our response rate and the greater the number of responses we get. So if you happen to be interested, if you happen to be part of an organization that has a business contact network, I would be happy to help get you connected into this. So in terms of the pandemic outreach, one of the things that we have developed because of this need for information is that we have a number of regular quarterly surveys right now. There's 2 general business surveys which access different businesses. We also have a construction survey that will be going out later this month, and a hospitality and tourism survey, as well as an ag credit survey. Today's focus, though, will be on what we call the general business survey. We did it in mid-January. We had a little over 1,000 responses, and we got really good response from across the district, which we're very happy about. I do have to tell you, though, that because this is not a scientifically sampled survey, the results are more snapshot rather than being scientifically valid. We believe these are really good representation of what firms are experiencing right now, but our ability to connect those the results of this survey to the previous survey are a little bit more difficult. So we just ask that you interpret with care. In terms of some of the survey takeaways, the fourth quarter has been a challenge for many businesses, which unfortunately that is occurring after something of a bounce back in the third quarter. What we find is that size, sector, state, and ownership of firms, those traits of firms are really big factors in terms of who is doing more poorly versus those that are doing better. And while some firms, depending on how you slice them up, are doing better than others, by virtually any way you look at the data, unfortunately, there are really no large groups of businesses that have had a net positive experience in the fourth quarter, and I'll talk more about that. And I'll also talk more about this, but the way to think about some of these survey results is that this is a good measure of how the universe of firms are doing. It's a less great representation of how the overall economy is doing, and that has mostly due to the types of respondents that were part of this survey, especially as it relates to the size of firms. So we have a lot of smaller firms that respond, which is actually real representative of the economy of firms overall. It's a less good measure of the overall economy because large firms have an oversized share there. And I'll talk about that a little bit more. So in terms of recent revenue trends, we asked firms a question to compare the fourth quarter revenues to 3 different time periods. So the very top bar, and maybe before I start with results, I want to give you an idea of how to read many of the charts that you'll see now. Generally, red means bad or negative, and green means good. The deeper the color, the worse the outcome for red, and if it's dark green, those are better results. So the way to look at this is we asked firms to tell us about their fourth quarter revenue compared to the same quarter last year in 2019. That's the top bar. Then we asked them to compare fourth quarter revenue to the third quarter of this year. That's the middle bar. And then their expectations for the first quarter of 2021 compared to a year earlier. That's the bottom bar. And unfortunately, what you see here is that there's a very notable negative trend in revenues among the firms that responded to our survey. Not terribly surprising to see fourth quarter year over year because we're comparing pre-pandemic to pandemic revenues. I think what's unfortunate is that from the third quarter to the fourth quarter, we also saw a net negative experience with regards to fourth quarter revenues. And unfortunately, even in the first quarter going forward, we're also seeing that negative outlook in terms of the first quarter. One of the big things that we're seeing in our survey, though, is that size matters. Okay, and what I'm showing you here is fourth quarter compared to third quarter by firm size. So what you have is the largest firms on the very top and the smallest on the very bottom. And you can see a very, very clear delineation of trends in revenue by size. What you're seeing is that large firms, it's not that large firms are all experiencing good results. You're seeing actually a little bit of a balance there, but it is still net negative. It's just that smaller firms are seeing much worse outcomes. So I just wanted to show you how size matters in terms of representation. So in terms of the number of firms that responded to our survey by firm size, what you can see is that many fewer large firms responded. That's not uncommon. There are just many fewer of them. This is actually a pretty good representation of firm distribution in the economy. But because small firms represent more of all firms in general, but they have a smaller share of output and employment, this is actually a less good representation of the overall economy, but it's a really good representation of all firms. So in terms of the economy in general, I think we can say that we're seeing better results because larger firms are doing better. So the economy itself is doing a little bit better than some of the results I'm showing you here. One of the other metrics that we look at is solvency. So just one more example of how small firms are doing more poorly is that you can see here very clearly we have we kind of draw a line in the sand in terms of if the current conditions persist, how long could your firm stay solvent? And we kind of put a marker in at about 3 months. And so the red represents those that think they cannot survive under current conditions for longer than 3 months. And as you can see here, smaller firms are in a much more soft financial position right now as it relates to larger firms. I think the other thing to say about solvency is that we were seeing very steady improvement in this measure over the last 3 or 4 surveys. And while they're not directly comparable, I think there's some margin of error here that we have to be careful with. We are seeing what I would call kind of a flattening of this measure since at least October. So we also asked firms to identify the state they were in. And what we're seeing here is that, again, every state is seeing net negative trends, but some states are seeing more negative revenue trends than others. I think part of this also has to do with it has to do with some of the response characteristics. In Greater Minnesota and the Twin Cities, we saw a higher share of respondents in sectors that are experiencing worse trends right now, entertainment, accommodation. I'll talk about that in a little bit. And in South Dakota, we saw probably the best overall results, but that response pool also tends to have many more finance firms, and those firms were typically responding in a much more positive fashion, which I can show you right here. So if you look at this chart in terms of responses by industry sector, what you can see here is that finance firms are doing on par, much better than the rest of the other sectors that we offer. So and those that are really dependent on crowds and face-to-face interactions, accommodation, bars and restaurants, entertainment and recreation, retail, those we've seen really since we started doing these surveys, we've seen that they have faced the most pressure very consistently. We also ask firms to identify their ownership structure. We're more interested in hearing about the differences between minority-owned, woman-owned, and veteran-owned businesses as it compares to the rest of the economy. And what we're seeing here is that I don't want to oversell this particular point, but we did see the negativity gap, what I'm calling, narrow, especially for minority-owned firms to the rest of the pool. I don't know if that's a one-time blip. I think there could be a lot of explanations, but we are seeing that the gap that was more prevalent in earlier surveys get narrowed somewhat. Now, the degree of decline is still higher with minority-owned firms, and there are also some other elements that really show that a lot of disparities really are still present. And here's one of them. I talked about solvency earlier, and you can see here also that the expectation of insolvency after 3 months is roughly 3 times the level for those that said none of the above in terms of ownership structure. So we know there are still a lot of disparities in the marketplace right now in terms of revenue trends. So quickly, some other results that the survey told us. We asked about the federal stimulus. Not surprisingly, it has been very, very widely positive. And for those, even for those that didn't say that it was a positive effect, basically said no effect. Not surprisingly, we didn't have many that had, a negative impact because there's an opportunity of this, of a lot of additional resources being out there. But here, what I would say generally is that we have seen some balance, a little bit better balance in terms of some resources getting to, throughout the size firms. But again, what actually here you're seeing is that more middle firms were getting, we had a more positive impression of federal stimulus. I think that is a little bit by design because I think while it's tough to always get resources exactly where you want them in this kind of large scale program, I think the policy was intended to try to help firms more in the middle, and it looks like that was at least modestly successful. In terms of workforce, what firms are telling us is that they are down, but hopefully going up. So in terms of of staffing comparisons, we asked them to tell us about staffing from a year ago and then from October. And basically what we see is that a lot of firms have scaled back in terms of their staffing levels. The good news is that that flips finally, and their expected staffing levels in 3 months from now was a net positive. So I think that's a really good sign, hopefully, for the next coming 3 months. They are also cutting wages to a larger extent, especially on the bottom end. Wages tend to be generally pretty sticky. So firms very often will actually cut workers before they cut wages. That has not been the case during the pandemic. So we have seen this as more of a trend. But again, as this chart shows, size matters. You are much more likely to be cutting wages if you are on the lower end. You can also see that the larger you are, the less likely you are to cut wages, and the more likely you are to be increasing wages. We also know that the pandemic is creating an awful lot of challenges to operations in general. So aside from slack demand, we asked them to just pick one of a number of factors. And I think the short answer is these are all probably issues for many firms, and some maybe stick out a little bit more than others, particularly the expense and inconvenience of COVID practices. We hear a lot about supply chain problems and disruptions, and even labor availability, again, because there's been a lot of the labor markets have been really lumpy in terms of which sectors are laying off, which ones are hiring. So we're hearing about a lot of those, a lot of that friction in the labor market as well. So in short, we know that demand is a problem. But even short of that, we know that firms are facing a really high number of challenges otherwise as well. What's real interesting in this survey is that the one piece of good news, I would call it, is that there is maybe more optimism than I would have guessed. From all of the other results leading up to this question, I would not have expected this particular level of optimism. It is net positive, not by a huge margin, but it is net positive in terms of optimism versus pessimism. And it's also an improvement in outlook from our October survey. So some of my quick takeaways from this particular survey is that it really does suggest that the fourth quarter was slower and a bit of a sideways step after what we saw in terms of strong output growth in the third quarter. It's hard to say exactly because we don't ask this question directly, but we assume that it's a likely response to the surging infection rates that happened kind of in the middle of the fourth quarter and from October kind of through mid-December. We know that rates are coming down since then, but we generally have been able to see a fairly, somewhat of a loose correlation between infection rates and general economic activity, particularly consumer demand. We know that small firms and minority-owned firms have been hit the hardest. We're trying to pay a little bit more attention to that so people understand how the pandemic is affecting different kinds of firms. And because large firms overall are doing modestly better, or at least less negatively, the overall economy is likely performing a little bit better than what some of these survey results suggest. I would not say that the larger economy is doing well, but again, the overall sentiment is probably a little bit more positive than what some of these results suggest. Staffing levels, and we're always interested in employment levels. They have gotten softer, but it looks like there might be some rebound into the first quarter. Insolvency still is a major issue for many firms, and unfortunately, it looks like we maybe have hit kind of a leveling off at a fairly high level in terms of firms that have some financial instability. But there is optimism. I think that probably has to do with the fact that vaccine is out there, it's getting rolled out, maybe not as fast as we would like, but I think it still offers hope, and I think that's where the higher optimism comes from. Moving forward, we're going to continue to be doing this. For those that are watching this video, and maybe you've been part of this survey, I want to say thanks. Your input and the input of literally thousands of other businesses have really been useful to the Minneapolis Fed in helping us really not only track, but understand what firms are seeing in the current economy right now. We'll be continuing this. I just want to give everyone a heads up that we'll actually be putting out a construction survey on February 16th that will run for 1 week. We'll also be doing a tourism and hospitality survey in early March. At least that's the expectation right now. If you happen to be seeing those surveys, if you're in those industries, I appreciate your input in advance, and let your friends know as well. I want to say thanks to everyone that's been watching this video, and look for future opportunities to learn more about what businesses are experiencing during the pandemic when we have these webinars in the future. Thank you very much for your attention. I appreciate it very much. Have a great day.